Setting up your webinar for Facebook Live.
That's very
It says
cool.
live on Facebook on mine.
Yay.
Oh, very cool.
Okay, I think we are officially live for the Phoenix Reia July event. Hello, everybody, and welcome. I am Dina Jones, the Director of Marketing and Strategic Partnerships for Fidelity National Title, and I am so excited to be joined here by today my partner in crime, Linda Bruce, who is Vice President at Fidelity and responsible for a lot of commercial business. Today we are talking all about commercial real estate and the state of the market. And we also have the one and only Mr. Chris Iman, who is live from the Bahamas. And I'm hoping he shows us some sharks. And Adam Finkel, who is the principal for Tower Capital and our featured speaker today. So Chris,
Hi, everyone.
I think we'll start with you. Can you show us some sharks?
Yes, so we're in the Exumas. If you're on Instagram, you've seen all the sharks. So there's only a few here. But those are all the nurse sharks on Instagram. Staniel Key Yacht Club right here. So we are live from Staniel Key Yacht Club here in the Bahamas. Little Bahamian update. The Bahamians are no longer accepting Americans after tomorrow. So my vacation was scheduled till Sunday and it is being cut short because the last American flight is Friday back to the States. Unless I want to stay till August, which I'm totally signed up for. So.
Well, we just want you to be safe, my friend, no matter what you do, and have good adventures, whether that's you come home this week or you come home in a month. We know you're always out there having a good time and enjoying your happy place because you can work from anywhere.
Right. And I technically do have a Bohemian rum punch with me on the show.
And normally you guys, when we're meeting in person, we we do our networking happy hour and definitely have usually cocktails and all kinds of beverages and food flowing at the Arizona Country Club. But in this world of virtual Zooms, we still want to keep things going, rocking and rolling. So grab a beverage of your choice or a snack, and we hope you enjoy this conversation. Hey, Chris, do you want to start by telling us kind of what you're seeing in the market from your perspective?
Well, yeah, obviously we're down to like 8,500 actives. So like anybody knows, it's a super hot market, and I could be like any other genius and say, oh, the Phoenix market is on fire, list your property, sell it in a day. But that's, I mean, we've seen this before in 2005 and 6. You know, everything's going to change. Everybody thinks that, you know, everything stays the same, and you could talk to that about a gym owner that was a gym owner, you know, 120 days ago, and now he's probably struggling for his life. So you never know what's going to happen. You just got to be prepared for it. So, but that's why we are going to have someone talk about commercial, because every guru in the town is talking about how Arizona real estate's awesome. Let's learn about something new. What's happening in the commercial world? What's the future of the commercial world look like? What's the future of multifamily like? And that sounds like a way more interesting topic to me.
Yeah, and that's one of the things I love about this group is that we have been able to really explore all different kinds of real estate investing, from, you know, notes, residential, iBuyers, and I'm super excited that, you know, today we are going to be talking about the state of the market from a commercial perspective, and really it's the first time that we have done this for the Phoenix Reia. So I will hand things over to you, Miss Linda, to introduce Adam. And while you guys are on Facebook Live, if you have questions, feel free to put that in the comments, and we will field those as we get them. So ask away, let us know that you're here watching. Linda, we have to have you unmute.
I muted because I heard the background. I was so afraid one of my dogs was going to bark, so I immediately muted. Don't talk, anybody. Hello, everyone. It is really my pleasure to introduce one of my favorite people and one of our really valued partners for many, many years, Adam Finkel. Adam is the co-founder of Tower Capital, a Phoenix-based commercial real estate structured finance firm. and they specialize in debt and equity placement in commercial real estate. Since their opening in 2015, Tower Capital has closed over $1 billion in successful capitalizations with investors, developers, owners, and operators throughout the entire country. Prior to Tower Capital, Adam was the vice president at Johnson Capital, where he was involved with the successful placement of over $360 million in bridge and permanent structured financing throughout North America. Adam, I know Adam personally, and so he has worked in every asset class of commercial real estate. He is a regular contributor to Forbes, and he's been featured in many industry publications as well as podcasts. He is a respected leader in our commercial industry, our commercial community, and he's been a panelist and co-chairperson on many industry programs and events. So it's with great pleasure that I welcome Adam and thank him for joining us today.
Well, thank you very much, Linda. Thanks, Dina, and thanks, Chris, for having me on today. Hopefully I'm as interesting as those nurse sharks and stingrays down there. I wish I was in the Bahamas as well.
Me too.
But, you know, Arizona is still a pretty good place to be, I think. And, you know, that really kind of brings up my first point where, you know, with everything going on in the country, in the world, Phoenix is a fantastic place to live, work, and invest. You know, a lot of the trends that we were seeing prior to COVID have really just been exacerbated by this. We benefit greatly from, you know, the influx of population from places like California, the Midwest, Canada, and the East Coast. And I think over the years, as more and more people have been exposed to our great state, that's just garnering more interest from, you know, people wanting to move here, wanting to invest here, businesses wanting to come here. So we have a lot of great things going for us. You know, there's a huge trend right now for people wanting to leave highly, you know, densely populated places and get more space. And, you know, you come out to Arizona and you're able to do that. You know, we've been seeing a lot of new development, a lot of new communities, the growth of the Southeast Valley, of the West Valley. You know, prior to the Great Recession, we really started to see, you know, tremendous growth out in the suburbs as communities, you know, like Queen Creek and Gilbert were growing, Goodyear, Litchfield Park. And, you know, when the Great Recession hit, you know, everything kind of sucked inward, and it was about, you know, building more density in the cities and, you know, just getting more of that urban environment, and really, you know, the growth of downtown Phoenix, which has been fantastic. And what we've seen is as the land values have increased and construction costs have increased, you know, now we've seen an expansion back out to those, you know, those suburbs, and especially with, you know, the expansion of the 202 and the 303, you know, that's really led to a lot of development out there. So, you know, look, I mean, if you live in California and, you know, maybe you're in San Bernardino County, you're in the Inland Empire, you know, you're not going to the beach too often anyway. So, you know, to move out to, you know, the Western Valley to some of these amazing communities that, you know, some of these locally based, you know, developers, you know, like DMB and some of these other groups that are building these fantastic communities that have so much to offer, you know, that's very compelling. And so, you know, kind of going along with that, you know, we've seen the growth of really a new asset class that started here in Arizona, and that's called single family build for rent. And so it's really an alternative to traditional multifamily housing. And it's also an alternative to traditional single family rentals. And, you know, there's sort of a stratification to the single family build for rent, you know, otherwise known as horizontal multifamily, where it could be, you know, houses built on multiple parcels in a community, or it could be, you know, more of an apartment style on one parcel that is just low density, that it's kind of maybe bungalow style or duplex style, where you don't have anyone living above you, below you, to the side of you. You have a nice yard, We're seeing a lot of people living in these communities have pets where, they want to have a yard. We're seeing, young families, moving in there. We're seeing, older folks, retirees who, are sick of all the maintenance of, a single family home. They can move in here, have some space, but you also have, all of the amenities of an apartment, of a Class A apartment complex. You have maybe a resort style swimming pool, nice fitness center, maybe there's like a dog park area, bocce ball. There's all different things that, are being built in these communities, and it's really caught fire. So we're seeing a lot of these new communities being built, both in Arizona and really across the entire country. So it's pretty exciting to see.
Well, you're totally speaking mine and Linda's languages. You kind of had me at puppy dogs. So we definitely know the need for space is changing, the way that people use their space, the way that offices are operating, the way that companies are running, since everything has happened.
Yeah, no, I mean, the way people use space is definitely changing, and, how we're going to come out the other side, not exactly sure, but, certainly when it comes to office space, obviously, a lot of companies have learned that, look, I mean, everyone can work remote. Everything's based on the cloud these days. You can work, from anywhere. And, while that may have been sort of scary to have, a lot of your staff working from home, now people are getting used to it, and they're seeing that, people can be just as productive. Maybe you're working non-traditional hours, but still the same amount of hours in a day. It's just maybe you're doing more early in the morning or at night or whatnot. So, as long as people are being productive and the work is being done, it's really working. And you're seeing, a lot of, large companies saying that, this is a permanent thing for them. I mean, you've got USAA, Facebook, Twitter, Square. I mean, all these different companies have now said, they're not going to require their employees, to come back and work in the office. So, besides payroll, office space and facilities is one of the highest costs for businesses. So to be able to not have such a cost allows them to invest, reinvest in their business. Maybe they can pay their employees more, they can invest in growth in other ways. Now with that being said, humans are social creatures, and we want to be interacting with each other. And, although Zoom, is a great way to communicate when you can't be together, ultimately, nothing replaces in-person contact, and, just being able to have that connection. So, I think that it's going to be challenging for companies to completely get rid of offices. I think an office will still be a place for people to meet, to collaborate, to share ideas. And, I don't think that's going away. I have young children, and, a lot of other people do. And, I kind of like to be in the office and, have that camaraderie with my other, coworkers, and not have all the distractions of working from home. And so I think that there's a lot of people that are going to want to get back to the office. But then there's a lot of people that say, hey, look, this works for me, and I don't have to commute, and, I'm more productive this way. Another thing that we're seeing is, people leaving these, big cities and wanting to move out to the suburbs. And when they're looking for homes, one of the biggest things is, wanting a home office. And so, you're seeing that on the single family residential side, a change there where, there's a different use of the space even in your own home. I think that, as far as retail goes, Gensler, which is a big architectural firm, they're based in London and they have offices all over the country. They did a study, of Generation Z. I think it's called Z now. I don't know if it's called Generation Y or Generation Z or what the final label will be, but it's the group younger than the millennials. And, they still want a sense of, the two biggest issues for them is they want a sense of community, and they're very big into environmental, and not, you know, having a big negative effect on the environment. And so, you know, again, it comes back to that sense of community where, you know, people still want to go and be around other people and not, you know, necessarily be isolated. I think that where, you know, now that people are more exposed to, you know, Zoom, and before that, you know, everyone was doing Skype, which isn't, I think, quite as user-friendly. But, you know, now I think that that will definitely have an impact on business travel. I think that, you know, business travel is very costly. It takes a lot of time to get on airplanes. It sucks a lot of energy out of people. And so now maybe instead of having to, you know, fly to all these different cities, you can get on a Zoom, you can still have that face-to-face. You know, but obviously, you know, we're all in real estate here, and real estate is a relationship business, right? So on the one hand, that Zoom is great. On the other hand, you know, you can't replace going and breaking bread with someone and, you know, having some drinks and, you know, getting together maybe at a ball game and different things like that. So, you know, I think that we're just learning to function in a different way, and really just being able to take sort of the best of both worlds, and, you know, really create a fit for everyone where, you know, ultimately it just comes down to efficiency and, you know, saving time and money. You know, another aspect of, you know, things that have changed pre-COVID to now is certainly, you know, the capital markets. And, you know, I own Tower Capital, and we finance all different types of real estate assets, whether it's multifamily, the single family build for rent, hospitality, retail, office. I mean, we do everything from ground up to stable to transitional. And one thing that we have seen is definitely a pullback in the capital. There's a lot of uncertainty right now. We don't know, you know, we're getting this second wave of virus, you know, certain states opened up and now they're shut down. We don't know what's going to happen in the fall. You know, what is the next stimulus package going to look like? And so, you know, as far as multifamily goes, you know, collections have been pretty strong overall, but, you know, as these stimulus packages are ending, you know, there's a lot of uncertainty, you know, what things are going to look like moving forward. You know, I think overall, we've seen definitely a pullback from the lenders. You know, borrowers are receiving less leverage that they were before. Maybe they used to be able to get, you know, 75% loan to value on a property. Now it's 70%. You know, the rates have definitely, you know, except for multifamily where you have the government sponsored entities, Fannie Mae, Freddie Mac, and HUD, which have, you know, provided a lot of liquidity to that sector and really have kept that sector going, you know, compared to other asset classes. You know, we're seeing some of the lowest rates, you know, I've ever seen in my career. I mean, I'm financing, you know, 10, 12-year fixed rate, you know, under 3%. You know, and when you add interest only to that, that produces a, you know, amazing amount of cash flow for investors. Some of the other asset classes, you know, haven't been so fortunate. When it comes to hospitality, financing for hospitality is pretty much non-existent right now. Very challenging. You know, a lot of those owners, you know, are really just barely holding on. Those with bigger liquidity positions certainly have more wherewithal to kind of weather this storm. You know, but I think that we're going to start to see a lot of distress in that sector at some point. We haven't seen it yet, but I think that that's coming. And what we're seeing is, you know, we're seeing investors starting to kind of jump into that market to try to find some of those some of those distressed opportunities to maybe look at a hotel or a motel and say, what is now the highest and best use for this property? Well, we have such a demand for housing, both single family and multifamily. Maybe it's better to convert this property into workforce multifamily housing. You know, right now, you know, there's a real difference between what's happening now and what happened in the Great Recession when it comes to, you know, residential housing, both single family and multifamily. In the Great Recession, we were oversupplied. We were way overbuilt. We didn't have, we had way too much product. It's exactly the opposite now. We're actually undersupplied for housing. So that's why we're seeing vacancy rates remain so low. Rents are going up. I mean, go and put your house on the market. If it's appropriately priced, you're getting multiple offers. They're bidding up the prices, and we're seeing that all across the valley. So, it really comes down to the supply and demand fundamentals. With retail, was already, challenged before. We've all seen shifts in, how people shop with, online and the growth of Amazon and, direct to consumer. So, that already had a challenge. What's going to happen with the malls? The malls, they're going to try to have to figure out what do we do with all this space? Multi-tenant shadowed anchored retail, is very challenging right now. If, for retail, if you've got, a long-term, single tenant, triple net lease with, with a credit tenant, you can certainly find a loan for that. But, if you've got a little retail center that has, 5 or 6 tenants and they're mom and pops and, that's going to be very challenging. And unfortunately, one of the groups that is really suffering in this sort of shutdown is the mom and pop businesses. The PPP program, it was rolled out very quickly because there was a need, to stop the bleeding. But, how effective was that when you're seeing, Kanye West got $2 million for, his company and, all these other big companies that are getting, millions and millions of dollars, and a lot of, small businesses have really been left out to dry. So, it's going to be very interesting to see how that plays out. And again, when it comes to commercial real estate, it's all about what is the highest and best use and how can they retrofit, those properties for the needs of today. We're definitely in a changing world. It's a changing environment. When it comes to bridge financing for transitional assets in commercial real estate, we do a lot of bridge loans as well. And there were many bridge lenders prior to COVID. It got very, very competitive. I mean, we were seeing spreads, LIBOR plus, high 2s, mid 3s. Now the spreads for, bridge lenders that are still active are going to be, 200-300 basis points more than that. So the cost of the money is definitely increased. The amount of leverage that the lenders are providing has lessened. And, another aspect of today is, how do we actually value these properties? It's really challenging to predict what kind of cash flow, right? Because how are commercial properties valued? They're valued upon the cash flow that the property is producing based upon a market cap rate. And so when you don't know, when you can't project what kind of income, it's very challenging to, calculate what the value is today. So, these appraisers definitely have some challenges. And, when it comes to multifamily, where I'm most active, and collections have stayed pretty strong thus far, we're still seeing, the appraisers, they'll appraise it based upon the numbers today, but then they'll put a little disclaimer that, because of COVID, we can't project, and, next month it might be totally different. We're also seeing a disconnect between buyers and sellers. Buyers are kind of sitting on the sidelines. They think that there's going to start to be, some distress, and, they're waiting. The sellers of multifamily are saying, well, my rents haven't been affected and my collections are strong, and, my vacancy is still low. And so, they think that the properties are still valued at, pre-COVID. And, what we've seen is that, for multifamily at least, we really are at pre-COVID valuations. And when you look at cap rates, there's actually a very wide spread in relation to historical levels between cap rates and treasury rates. So I think that there is room for cap rates to compress and values in multifamily to be maintained. As far as the other asset classes, I think certainly we're going to see a widening of the cap rates for those asset classes. Particularly hotels, retail, and office. Industrial is still very, very strong. Really the two darling asset classes over the past few years have been multifamily and industrial. Certainly with the growth of Amazon and online retail, they need a place to store all of these goods, and you're seeing high demand for distribution centers. We're seeing high demand for data centers, and West Phoenix especially has become a huge hub for a lot of manufacturing and distribution, where goods are coming in from California, hitting West Phoenix, and then they're going south, they're going north, they're going east. And so again, Phoenix is very, very well positioned to be a very, very strong market for the foreseeable future, given all of the tailwinds and all of the trends that we've seen that have just been exacerbated since COVID has struck.
I think you make so many good points, Adam. And Chris, I'm not sure if you have audio or not, because you are out there viewing the sharks, but I know we talked last month a little bit on the changes that you've seen in your world with regards to the financing. Have you made any changes or seen anything different since we've had kind of the second wave hit us?
No, I mean, obviously, I'm obviously a private money lender in the residential space. So obviously when all this happened in mid-March, almost every private money lender just quit lending in the residential space. I would assume that happened in the commercial space as well. I'm just not in that space. So, but yeah, now, because obviously everybody knows that the residential market is so strong that every hard money lender that pretty much opted out is pretty much back in. So,
well, and Adam mentioned the financing being really non-existent almost when it comes to the hospitality industry. Are you thinking maybe you want to investigate putting some hard money over there?
Well, obviously hard money is risk reward, right? So just like all hard money, it's like and I've always lent on what asset do I want to own. So, that's why I've always kind of stuck with, residential.
Yeah, so if you have to foreclose on somebody, you get the house. Is that what you mean?
Yeah, basically. So.
Awesome. And I know we have a couple
these days. But, as far as the private lending goes in the commercial side, we've definitely seen a lot of players step out of the market, and that's why, rates have gone up and there's just not as many people in there. And what we saw was that, a lot of lenders, and this goes for banks as well, traditional and non-traditional capital, was stepping back and going really into asset management mode. They were seeing, they were looking at their portfolio of loans and seeing, what has potential to come back to us, and really reaching out to those borrowers, and, especially in retail, office, and some of these other asset classes. So, they're putting all their resources into managing those assets and, not going out and financing and originating new opportunities. And as well as landlords. I mean, for landlords right now, it's very, very wise to be extremely overly proactive with your tenants and reaching out to them and finding out what's going on. And, the thing is, it's like we're kind of all in this together. And so, we all need to help each other out and figure out how we get through this. And, to some degree, it's going to be, just trying to kick the can down the road, almost like in the last recession, until things bounce back a bit, because, none of these lenders want a wave of properties coming back to them. Ultimately, they're not in it to own and operate these properties. They want to lend money, and that's how they make money. And they let the borrowers, the operators, go and operate the properties, who can probably do a much better job. So, we're seeing a lot of, people trying to work together and figure this out. It'll be interesting what the next stimulus package has to offer. I'm not exactly sure if they're going to extend the supplemental employment benefits. Certainly, I don't think it's going to be an extra $600 a week or whatever it is now. That will probably get scaled down. I know in the real estate community, if there isn't an extension of that, some sort of rental assistance package to help renters, pay their rent. There's a big push for that. And certainly for commercial real estate on the ownership side, getting rid of a moratorium on not being able to evict people, because it really ties the landlord's hands of being able to run their property. So I kind of have different thoughts on that. As just being a member of the community, you don't want to see certainly people being put out on the streets, and people with children being put out on the streets. Yet at the same time, how long can it go without people having to pay their rent? And the landlords, many times they've invested a lot of money, all of their money, sometimes for smaller investors, into this property, and they still have their bills to pay, and they still have their mortgages to pay. So it's a very challenging time that people are really trying to figure this out, and there's a lot of uncertainty right now. I mean, that's the biggest thing. With all the uncertainty, it's very difficult for people to plan and, for people to move forward.
Well, yeah, I mean, we were talking about that even before we went live. It's like you guys, even just in your office, you were on the trajectory to move everybody back into working from the office, and then the second wave hit, and now you guys are all back home. I mean, I think that most companies are experiencing that across the board, and so the need for space is definitely in flux, right? I mean, we don't know what we're going to need in the future, really.
Exactly. So, what we're seeing is, shorter term leases, shorter term extensions being signed. I think for the second quarter of this year in Phoenix, there was about 680,000 square feet of sublease space that came on the market. And so, that's a tremendous amount of space. And, not all that space is going to be, reabsorbed. And, there's not a whole lot of people that are out there looking for space right now, but certainly, it will benefit, those tenants that are looking for shorter term opportunities, often to come into a sublease situation, maybe all the furniture is intact. And so, there's definitely, a need for that type of space, in today's environment.
And are you seeing any trends where people are saying, I for sure only need 10% of our office space moving forward, and so trying to get out of their current, long-term leases, or is it just too premature for that?
Yeah, well, I think it's, people are really businesses are trying to figure out how much space they're going to need moving forward. And, that's why you are seeing a lot of these businesses right now trying to sublease, their current space, because you can't necessarily, just walk away from a long-term lease. And so, they put it on the market hoping someone else will come in. But, some people say, some businesses, they'll need a lot less space. more people will be working from home. Some businesses will just want less density of workers in their space. So, to have more social distancing. So maybe they're staggering the workforce. Maybe some people are coming in and they're working every other day, or, some people work in the morning, some people work in the afternoon. And so, they're still using the same amount of space, but in a different way. There's been a huge trend of, big open space with a lot of cubes with people, or workstations with people packed very densely in. And so now, we might see a trend of giving people more square footage. And, maybe people will need the same amount of, net space because of that. So there's really a dichotomy of, two different ways it could go. I believe that, businesses are just going to need less office space these days. And I think that a lot of businesses are going to, people are going to work from home, and they're just going to figure out a way to use less space because, that's much more cost efficient. And so, ultimately it comes down to dollars and cents, and, people can come in the office, less often, but still come in once in a while to have that face-to-face and, have that collaboration. But I think that the trend of more people working from home is definitely here to stay.
So I have a question.
Yeah,
oh, sorry.
go ahead. No, go ahead, Chris.
So in the massive residential downturn of 07, 08, obviously these big funds, i.e. Blackstone, they come in and they snatch it up. I mean, are most of these commercial buildings or, space that you have seen or manage or represent, are those owned by big companies like that, or are they more owned by mom and pops, and Blackstone too is going to come up and gobble up, strip malls and figure out how to repurpose them, whether it's into storage or churches or, stuff that obviously is still probably doing all right now?
Sure. Well, it really depends on the size and scale of the property. And, when the recession hit and, there was all these empty houses and Blackstones and these other companies came in, that was really planted the seeds for the new single family build for rent asset class, because what happened was all these big companies bought all these properties, but what they realized, it was very inefficient to run these, to manage all of these properties, right? Like if you have an apartment building and you have all of these units and everything is in the same area, then you can have a day porter and people go from unit to unit and, across the property. When you have houses that are all over spread out, in a particular metropolitan area, it's very difficult to effectively manage, those assets. And, we've seen a lot of these big, private equity groups really get out of that space and really putting all the, a lot of money into the new single family build for rent. So, for instance, we're financing a large, close to 300 unit single family build for rent property out on the west side where, we have put into place a low leverage, 51% LTV loan with a bank, a non-recourse bank. And then, we're talking to a number of private equity groups to come in and be partners on the equity side. And you're seeing a lot of these big private equity groups wanting to get into this space, partner with on the ground developers and operators in certain markets and just kind of do, a rinse and repeat. As far as going back to the commercial, again, it's the size and the scale. I think some of these larger malls, you're going to see, have to see a big institutional group come in. You'll probably start to see, institutional groups, picking up, portfolios of hotels and probably converting them to multifamily. You're seeing independent, developers and value add investors beginning to do that. You know, they're really on the forefront, but it's only a matter of time before the big money catches wind. And it's really ultimately about, you know, how can they produce more yield? And as, you know, cap rates become compressed in different asset classes, you know, the money flows into other assets where, you know, they can receive more yield. You know, and the retail as well. I mean, it's just about someone being creative and figuring out how to change the use, and then all the others catch on, and then that's when you start to see the big money flowing in.
Well, how about that, Chris?
Well, that's the reason for this, that we're here, is like, he's saying it, like all the investors that are out here in Phoenix, Arizona that are, I mean, if you're an investor trying to get a single family fix and flip, you know, it's the hardest thing to do on the planet right now, or a wholesale deal. So it's the guy that makes the most money in the next 2 to 3 years. And that's why we're here today, is the guy that can figure out how to take, you know, get a foreclosure on a strip center or whatever, repurpose it, get it leased back up, and then use it for cash flow or sell it. Obviously, that's where the money's made.
Mic drop.
I mean, you know, the market, and I hate to use the term, you know, frothy, because it's very overused in my side of the business, but, you know, the market had gotten super frothy, you know, pre-COVID, and, you know, you have a tremendous amount of capital sitting on the sidelines right now waiting to be deployed. You know, I mean, you look at a person like Warren Buffett, and the guy has billions of dollars that, you know, they're just sitting on, and you have all these big private equity funds, and you have, you know, a lot of people like me that just, you know, have my own money, and I'm, you know, been waiting for opportunities, because, you know, no one wants to buy at the height of the market or when you feel like it's the height of the market, right? And so, you know, when we see these kind of, you know, recessions, you know, that always, you know, presents opportunity to people. And, you know, it's the ebb and flow, and it's, you know, the natural, you know, occurrence of the market cycle. And maybe, you know, a longer expansion this time around, but, you know, things are always gonna, you know, reset back to, you know, lower valuations at some point.
Yeah, I think you're absolutely right. And I know we've got a few questions that people are asking throughout this conversation. Linda, did you want to start with one of those?
Yeah, happy to do it. I'm not sure I'm viewing what you're viewing. I'm looking at chat.
Yeah, so why don't we start with on your list of the questions that were emailed in?
So one of the questions that there was, Adam, was the fact that are you seeing in the commercial world, whether you're an investor, developer, are you seeing any switch from one asset class to another? So for a perfect example would be somebody in the hospitality industry, we know many who are now, you know, would they be considered with opportunity going into possibly a receivership, or would they change asset classes and diversify in the commercial market? What are you seeing anything in that area?
You know, I'm definitely seeing a lot of money flowing into multifamily, single family build for rent, and industrial.
Okay.
And, you know, and sort of out of the other asset classes. Now, you know, for an individual owner operator, there's certainly going to be a learning curve. You know, a hotel operator doesn't necessarily know how to run an apartment building, or, you know, doesn't necessarily, you know, have the know-how to go out and, you know, buy a flex industrial property and understand, you know, those types of tenants. You know, but I think that that's where hiring, you know, strong local, you know, leasing representation comes in, strong, you know, local property management, and, you know, utilizing those groups to provide, the expertise and know-how. So yeah, I mean, certainly, there's a lot of interest, in the industrial, multifamily, and the single family built for rent. And you're seeing, a lot of, international groups as well wanting to come here and invest in those types of products as well. A lot of groups from Asia, Saudi Arabia, they still want to be here in the United States and, in multifamily housing, where it's, it's thought of as a very safe place for their money.
Absolutely.
And, people still want to, despite all the craziness, unfortunately, that's happening in the country this year, this is still the greatest country in the world. And this country still provides the most opportunity than any other country in the world, despite, what we hear a lot. And, people from other countries realize that, and they want to be here, and they want to come here, and they want to take advantage of that. So, we're certainly seeing that. And, that's another reason why, our treasury rates and treasury yields have been so low, because it's still, the safest place for, all these sovereign funds to be, putting their money into, U.S. Treasury bonds.
Exactly.
Yeah, and for those of you guys who are just joining us, we are having an amazing conversation with Adam Finkel from Tower Capital regarding the commercial market space. And if you guys have any questions that you want to drop in the comments on Facebook or via email, you can still send those in. It's not too late. And did we have any others that were emailed in, Linda, to go over?
That's all I had, because two of them Adam actually went over, which was really the commercial real estate pre-COVID compared to COVID, right now, and also just the future of it. And Adam, you said earlier you were in a pipeline meeting call, and I think you've discussed it in good detail. But the idea that, where do you see us in, October, November, fourth quarter, moving into the first quarter of 2021? Where do you see the commercial market in, overall? It feels, when we look at it, and Patty's on the line too, when we look at it from a real estate side, from what we're seeing on closes and open orders come in, it feels like we are progressing, and we're moving back into what is going to be a new norm in the commercial real estate side. What are you seeing on that future in the next 6 months?
Yeah, look, I mean,
Crystal ball.
yeah, it's hard to say, but, I believe that at some point we are going to start to see some real distress. I mean, quite frankly, we just haven't seen it yet, really, in any sector. As much as I've been hating on, hospitality and, speaking a little negatively of retail, people are still managing to hold on. But I think that you can only kick the can down the road, for so long. And, we see a very high stock market right now, but, a lot of people, millions and millions of people are out of work. Those jobs are not coming back. And so, at some point the chickens are going to, come home to roost. I think that the second stimulus package, may kick the can down the road even further. But at some point, I think we are going to start to see some real distress. You're going to start to see, a lot of foreclosures. But again, that's just going to breed opportunity. And, I think for really the individual investor, there still is certainly going to be opportunity out there. What I would say is, if an investor is going to, go out and try to buy, maybe their first, maybe they've been investing, they have a bunch of single family rentals, portfolio that they're building up, and now they want to dip their toes into, multifamily. What I would say is a couple of things. I would say, start small. Buy, a 5-plex, a 6-plex, an 8-plex. figure out, how to run that property. And then you can kind of build from there. One thing that we are seeing is, lenders really putting more emphasis on borrowers' global portfolio, and kind of, what kind of cash flow are they producing from their other assets. And, before it was just really kind of a focus on, what is the person's net worth and liquidity, and, kind of what is the in-place cash flows of the property and what kind of loan can that property support. Now they're looking at it on a much more, holistic and global basis of, what other assets does this person have, and, can distress in some of those assets, affect the rest of the person's portfolio. And so, kind of some rules of thumbs, if you're going in and you are interested in trying to, buy your first multifamily property or grow your multifamily portfolio, when it comes to lending, sort of the two, rules of thumb are: the lenders want to see a net worth equal to or greater than the loan amount, and they want to see liquidity after the down payment of about 5 to 10% of the loan amount, or sometimes they want to see an extra 12 months of loan payment. So they want to make sure that someone's not dumping in every last penny into the down payment, that they have money for if things come up, they need to replace the roof or HVAC, that there's money there. Usually the lenders are looking for at least a 1.25 debt service coverage ratio on the property. So that means that the in-place cash flow that the property is producing is 125% of what the annual mortgage payment is going to be. So there's some cushion there if collections do lessen at some point, if they do lose some tenants, that there's still some cushion there. They really want to see, often, what type of experience does an investor have in that particular asset class. So sometimes it can be challenging to jump from, if you've been a retail person now to buying a multifamily, but you have to start somewhere. And that's when I say, sometimes start small. Maybe the financing isn't going to be the best that it could be. If you were more experienced and had a larger portfolio, maybe it's a little less leverage, maybe it's a little bit higher rate. But once you buy your first property, it gets much easier from there. And that's really something to build off of. And again, I think that there's going to be opportunities in different asset classes. And so I think if people can get creative and figure that out, there's going to be tremendous opportunity and a lot of money to be made in some of these other asset classes.
Yeah, and I think that you are bringing up so many really amazing points, Adam. And, for somebody that might be part of this group and has never been in the investing side of commercial real estate, I mean, where do they start if they're interested in getting involved in that? Where's a good place for them to start?
Yeah, I mean, I think that you start to build your relationships, and, they start to build relationships with, some of the investment sales brokers, the active investment sales brokers. They start to talk to some of the property management companies. And really, ultimately, it just comes down to looking at deals and underwriting a bunch of deals. And you learn by doing. And so, look at a bunch of deals, start small and build from that. That's the advice I would give.
I think that is really good advice, and really appreciate you being here with us today. And I think that, what I just keep hearing in my head over this conversation is just the fluidity of the market, and, the kind of semi-uncertainty as far as like, what does the future really look like? And obviously optimistic that, money's going to be moving maybe from one class to another. And I'd love to see if maybe, you can join us again in a couple months to continue the conversation and see, where things are, this fall maybe.
Sure,
From
absolutely.
your perspective.
I'd love to. Just let me know.
Okay, awesome. Did I miss any questions or anything, Linda?
No, that was perfect. And Adam, love the detail. So appreciate you being here today. We really appreciate the time, and I love, you know, in the beginning it was like 15 minutes is good, 30 too much, and it's amazing once you get started how interesting all the asset classes are, and you gave us a really broad look, so thank you very much.
Yes,
Thank you.
I agree. And absolutely a valuable conversation. For those of you guys who are watching this live, if you do have other questions after the fact, always feel free to reach out to me or Linda, and we can help connect you guys with Adam. Chris had to drop off. I think he's going to go swim with some sharks since he's probably coming home this week. But he did want me to remind everybody that we are here the third Tuesday every single month via Zoom land. Who knows where he's going to join us from next month, but we will be sure to, you know, continue the conversation about different forms of real estate investing and hoping to provide you incredible content. Adam, you are amazing. Thank you so very much. And Linda, thank you so very much for being here and being part of this conversation. And hope everybody has a great week and look forward to seeing you on Facebook Live in August.
Thank you very much. Thanks, Adam.
Thank you.